here with Professor Jeffrey Frankel. He's Professor of Capital Formation and Growth at the Harvard Kennedy School of Government. Welcome to Colombia again.
Thank you. Gracias.
Professor Frankel. So, first question, which obviously is your topic that you manage very well. Let's start talking about the United States and the current situation for growth in the US. So apparently in the past 6 months we're having a little bit better numbers, kind of mixed but better numbers. But the Federal Reserve still holding its view, or at least telling to the markets that they're planning on keeping, in theory, interest rates on hold in very low levels until at least the end of 2014. First, on growth. How do you see the situation of the U.S. going forward for this year? Because there's a lot of challenges going forward. Europe, fiscal adjustment at the end of the year. There's still a lot of things not working very well. Unemployment has been coming down, but things are not, that don't look extremely well. What's your view on the situation of U.S. growth for this year?
So U.S. growth has been pretty steady, not what we would like to see, especially coming out of such a deep recession, but nevertheless pretty steady for several years now. And there's been a bit of an annual cycle of thinking, okay, now things are going to be much stronger, and then tempering that. And as you say, there are these risks that could hit us at any time. But you know, I think we can do 2.5% growth this year if none of the worst case scenarios, shocks around the world and so on, materialize. And that's enough to bring the unemployment rate down very gradually, as it has been. Again, it's not the rate of job growth that we'd like to see in an expansion, but it is consistent with our previous two recessions, where the job growth lagged a bit behind. And actually, you know, the rate of job creation in the United States, and particularly in the private sector over the last 2 years, has been slightly better than it was over the preceding decade, even if you take out the recessions, even if you just look at the expansionary period between 2002 to 2007. Nobody realizes that, because of course the unemployment rate level is still high, and we're not really where we would like to be.
So, but there are two, I guess, well, I have a little bit of two concerns. One, when it comes to unemployment, even though the unemployment rate has been coming down, when you look a little bit further into the numbers, first there's a problem that long-term unemployment keeps being extremely high. It's at the highest level, or close to the highest level, in over 50 or 60 years. Second, the quality of employment also doesn't seem to be very good. Part-time unemployment seems to be at a very high level, while full-time employment part-time employment seems to be high right now, and full-time employment seems to be extremely low. And also, the participation rate in the labor force keeps on coming down. So, would it be possible that maybe some of the progress that we've done on unemployment so far, at least in the past few months, is going to slow down considerably, and then we're going to hold steady at a very, around the 8% for a while?
You know, until 5 months ago, the mystery was why people asked, how come the growth in GDP is not being reflected in jobs? So we had 3 very good months, and relatively speaking, in job growth. I'm not so concerned about the part-time employment or that. I mean, it's a pretty standard thing. That in the earlier stages of a recovery, firms are reluctant to hire workers, and you see it show up in part-time employment. And you see it show up in overtime. The length of the work week goes down in the recession and then comes back before the firms are ready to hire more workers on a permanent basis. So that part's not so worrisome. But the thing you mentioned at first is very worrisome, which is the very high level of long-term unemployment. Because when people are out of the workforce for a year or 2 years, they lose skills. It has a very high psychological toll, of course, but in addition to that, it has a lasting economic toll, and shows up permanently, at least for a long time, in the natural rate of unemployment and in the natural rate of growth. And we saw that in the 70s and 80s. It took a long time to come back from that. So that is quite worrisome. And, you know, in a sense, it's not surprising, just given how deep and long the recession was. But it is a very worrisome aspect of it.
What about automatic fiscal adjustments? By the end of this year, if nothing is done in Congress, probably north of $500 billion of fiscal adjustments will take place for 2013, which is about 3% of GDP in the U.S. Are you concerned about that, especially because it's an election year?
Well, the fiscal situation is extremely concerning. I mean, I wouldn't say especially as it's a fiscal year, except that, as usual, that's a kind of excuse to postpone doing anything about it until after the election. No, I mean, you know, we discussed, mentioned the fact that there are these big risks or shocks out there, and some of them are external, like the euro or the price of oil, but some of them are homegrown, and the U.S. inability to manage its own fiscal situation in a halfway sensible way is quite worrisome. I mean, we're as bad as the Europeans, and we don't have the excuse of 17 different parliaments that are hard to coordinate. We just have one. And, you know, the solution to the fiscal situation, I think, is pretty obvious and pretty straightforward. Namely, what we should be doing is simultaneously not withdrawing fiscal stimulus, which is what we are doing, but rather creating a little more fiscal stimulus because the economy is so weak, and yet at the same time lock in steps towards long-run fiscal responsibility. Not give speeches about how important it is and not promise impossible things the way some of the politicians who consider themselves the fiscal conservatives do, but actually take steps to lock in progress in the longer term and do that at the exact same time. But instead of that quite sensible policy that I think most economists would agree on, from across a pretty wide political spectrum. Instead of doing that, we have these awful political showdowns like we did last summer over the legislation to raise the debt ceiling, where some of the people in Congress seemed to be saying that there's no problem if we default on the debt, you know, which is just amazingly irresponsible and contributed to heavily to our being downgraded by Standard & Poor's from AAA to AA. And so I am very concerned that at the end of this year, November, December, that we may see something like that again. Because as you say, if nothing is done to change any laws, we have all of the Bush tax cuts disappearing, and some of that wouldn't be such a bad thing, but all the Bush tax cuts disappearing, all the Obama tax cuts disappearing, and in addition, what's called sequestration, which is very drastic cuts in both military spending and non-military spending. If the economy is hit by all that at once, that would send us back into recession.
So then what about the Fed? Should the Fed do more?
You know, the Fed has done so much, and if it comes to that, if we're hit by any of these adverse shocks, the Fed should do more and will do more. But the thing is, there's not a whole lot more that monetary policy can do. Interest rates have been rock bottom for a long time now, and you know, the central bank does what it can do. But in my view, is the primary responsibility should be fiscal policy.
But half of the economists in the U.S. are thinking still that their base case scenario is that the Fed is going to adopt more steps, you know, QE3, in later this year. Do you agree with that camp, or are you on the opposite camp?
Well, I mean, the Fed, I don't think is going to adopt it won't explicitly say we're doing QE3, quantitative easing 3, but I think it will continue to do what it's been doing for several years, which is follow easy monetary policy and look for creative ways of doing that. I don't think, I think they're doing it right, approximately right, which is not to rush into something that might be called QE3 before there's a clear need for it. And also to keep your powder dry. I mean, if we reach a situation where everything that can possibly be done has been done, that might alarm the markets in itself.
Right. So let's jump to the other side of the Atlantic, Europe. Okay, so we kind of passed the problem of Greece, kind of. And now Spain is the big problem right now. You look at the numbers and it's actually very scary. Unemployment in Spain is at the highest level in decades, and it's the highest in the Eurozone. Youth unemployment is also extremely high. It's even higher than in Greece, which is north of 52%. Plus, you have a lot of fiscal austerity measures. How does Spain get out of this trap? because, you know, fiscal austerity, the markets are pressing for that. How is Spain going to come out from this situation in the short run?
I don't know. I do not have a good answer to that question. I don't think anyone does. By the way, I don't think we're done with Greece. I think they'll be back.
I agree with you. I think Greece is going to have another restriction at some point, but
right.
So far.
That's right. No. I mean, the problem was kind of solved for the time being, and more generally, maybe with the eurozone, just we've been coming through a period where it's eased up a little bit, partly thanks to the aggressive actions of the ECB under Mario Draghi, and partly the new the technocrats in Greece and Italy. But I think we all knew that the problem had not been solved, or it was not going to go away. It was going to be back pretty soon. And yes, Spain is currently the front line, and it is very worrisome, and it is very hard to think of what they should do. And in Greece's case, one feels sympathetic for Greeks that are suffering. There's a sense in which it was their own fault for all the years of living beyond their means and of all the structural impediments in the economy. In the case of Spain, I have extra sympathy for them because I think they've had followed pretty good policies over the last 10 years or more. And yes, they had a housing bubble, and the crash is what caused this. But they couldn't really respond to the housing bubble. They can't really respond now to the recession because they don't have their own currency. They don't have their own monetary policy. So, I mean, the case for the euro in general is certainly looking weaker than most people thought when it was launched, or in its early years. I have there are various places where I think the policymakers could have made a different decision and things might have gone differently in managing the Greek crisis and so on. But it's very hard to answer the question of what should Spain do now.
What do you think is going to happen with the eurozone? Is the eurozone going to be as it is today? I mean, the composition of it, is it going to be the same in a few years' time, or do you think some countries are going to eventually be either expelled or drop out, or what do you think?
It's just, I mean, it's such a hard question to answer. If there were some legal provision for countries to leave, then yes, of course, Greece first, and then perhaps some of the others would be good candidates to leave. That they would, especially if you're going to default anyway, then that's a great time to also go back to your own currency, and if that's what we think is in the cards for Greece. But it's just, I mean, I don't know the answer to your question. I suppose at some point somebody will leave the euro, if I had to bet. But the costs would be very high. It wouldn't. How do you do it? I mean, if you start debating the legislation, either at the national level or at the especially at the treaty level, to do it, then every last drachma, euro that's in a bank, or peseta that's in one of those banks is going to be withdrawn in anticipation of the fact that they'd be devalued by a lot after they withdrew. So that gives, that itself would make the problem worse. So, I mean, I'm very pessimistic on the euro crisis. Have been all for 2 years, but I don't know that it's going to break up. And I'm confident that it will. That even if a few currencies were to leave, that the euro will go on.
You were an economic advisor for Angela Merkel. What would you advise her to do?
Well, I think that Angela Merkel is making some mistakes. I mean, I understand the frustration of the Germans, that the German voters and taxpayers have, from the very beginning and for 20 years, have been worried. Their number one worry has been that the euro project would, in the end, result in them having to bail out some Mediterranean country that had lived beyond its means, and the elites told them, no, we've got it all worked out. That we have the Maastricht criteria, we have the no bailout clause, we have the Stability and Growth Pact. But it turned out that the voters were right, the taxpayers were right, and the leaders were wrong. So I understand exactly where the Germans are coming from. Having said that, I just think they're getting it wrong. If they think that austerity promotes growth in any kind of short-run sense, I mean, it's just wrong. And you see it in Greece, you see it in Spain, you see it in the UK. that doesn't even have the constraints. And in addition, I mean, I think that's one mistake they're making. In addition, the proposals that Germans are making for how we will try to make sure that this doesn't happen again, the fiscal compact, to my mind, is just clearly not workable. It's the same, basically the same thing as Stability and Growth Pact, but just saying this time we really, really, really mean it. And it's very popular among economists and some policymakers to say the solution is to have rules. But rules that aren't credible, rules that don't have any enforcement mechanism, don't help the situation and maybe hurt the situation. I mean, a good test case for whether a rule is credible is if it's violated, if it turns out the budget deficit goes above the target, who does what? Who gets punished in some way, whether it's political or criminal or some way? And writing a fiscal rule that has that kind of credibility behind it is quite difficult. And I don't think the Stability and Growth Pact was such a rule. It clearly wasn't credible, was never enforced. And I don't see that the new proposals that are coming out of Germany and Angela Merkel in particular helped with that.
I'll tell you the thought of the fiscal rule. I'll ask you a question a little bit later about that because Colombia adopted a fiscal rule just this year. But before going into Colombia, let me ask you about emerging markets. I saw an article that you wrote probably at the beginning of this year, or maybe at some point last year. I think the title was, Will Emerging Markets Fall in 2012? So I wanted to have your view on that, if you still hold the same view, or if you're a little bit more optimistic on that view. Basically, just for the viewers to know, you were a little bit pessimistic on what may happen for emerging markets, not necessarily 2012, although that was the year that you put in your title, but for the next 2, 3, or 4 years or so. Can you explain us a little bit what was your train of thought, and what is it that you think right now with the outlook might seem for emerging markets?
Well, I mean, first, on a big picture, I have been for quite some time very bullish on emerging markets. I think we've seen an historic change where not all, but most emerging market countries have done quite well, and have, not just because of high commodity prices, but because of good policies, and they've learned a lot of lessons from the past. And so the quality of the fiscal policy and monetary policy and so on is much higher than in the past. And interestingly, during the same period, the northern countries, the U.S., the UK, Japan, and the Eurozone have made a lot of mistakes. I think the quality of policy making among most developing countries now is better than in the northern countries, and that's part of why they're seeing such strong growth. But in the op-ed that you mentioned, and it was raised as a question, will emerging markets fall in 2012? But I did express some possible worries, and I think some emerging market countries are vulnerable. What the article said is that there is this disturbing 15-year pattern, and I talk about go back to the Bible. If you remember the story of Joseph interpreting the dream of the Pharaoh as 7 fat years followed by 7 lean years. And that is precisely what the pattern has been in emerging markets. We've gone through 3 cycles. So there were the big inflows after the oil shocks from, let's say, 1974 to 1982. Those were the 7 fat years. And then there was the lost decade in Latin America, which was basically 1982, the crisis in 82. Starting, and then for most of Latin America, 82 to 89 was a very difficult time. The net capital outflows and slow growth, if any growth. So that was the 7 lean years, and then it started over again with the capital inflows of 1989 to 96. Those were the 7 fat years, and then we had the East Asia crisis, 97, and continuing to Russia, and also eventually hitting to some extent Brazil and everybody, and Argentina, 2001. So that cycle would say that we're due again in 2012. That if it's a 15-year cycle, 1982 being the end of the first boom and the first international debt crisis, and 1997 being the East Asia crisis, and then that gets you to 2012. Now, why? Is this just because it's in the Bible? No, I think it's because people tend to forget, because 15 years is long enough that people have moved on to other jobs, portfolio managers and traders and all that. And they think this time is different, and they get carried away with the enthusiasm of what usually is some genuine good fundamentals. So I think that there is the possibility. I mean, we're almost halfway through the year, and emerging markets have been doing quite well. But you see slowing down. I mean, China would be the biggest concern, of course. And there is a possibility of a hard landing in China. Some slowing down is desirable, coming off of last year where they had this clear overheating and the real estate bubble and the rest of that. And so there, a hard landing would take the form of the problems, bad debts from the local governments and the banks and some of the loans that they made based less on economic grounds than on other criteria. I guess the single major emerging market country that I think is most vulnerable at the moment is Turkey, because they've had high growth, but I think maybe unsustainably high growth. They have a huge current account deficit. They'd be very sensitive to an increase in the price of oil, for example. So that one I think is pretty high risk. For Latin America, things look good. But for example, if China did have a hard landing, then the demand for raw materials for oil and minerals and agricultural products worldwide would go down. Prices would go down, and that would have an impact on Latin America.
Right. I was going to ask you about China, so you already answered my question. But do you think China is following the steps of Japan?
Do I think China is following the steps of Japan? Well, in some respects, yes. And if you look at trade relations with the U.S., there's so many parallels. But I mean, China is different Japan, obviously, in many ways. And probably the most important way is that it still has a long way to go before income per capita catches up with the United States. So what happened in Japan, and then subsequently in Korea and some of the others, was an inevitable growth slowdown. I mean, you don't go growing, and China will have to slow down. You don't grow at 10% a year forever. If you're coming from way behind and you have low capital labor ratios and a high return to investment and high productivity capital, and you're learning the technologies from the advanced countries by emulating them. I mean, it's not that easy to do, but once you find the formula, you can really grow pretty rapidly. After your technological knowledge has gotten close to the frontier, and your management techniques are close to the frontier, and after your capital stock is much higher, and you've started, by now built every train and every road and every bridge that you want to build, then you start to slow down. That's inevitable. What happened to Japan is it was a very leveraged economy. The high dependence on bank loans worked fine when they were growing very rapidly, but that doesn't work. I'm talking about corporations, source of capital for corporations. High leverage doesn't work when you slow down. And I think that's an overall diagnosis of why the Japanese economy basically crashed in the 1990s. And Korea and some East Asia countries went through something similar in 97, 98. And so China, that's the question. Will it have a hard landing like that? We're already seeing real wages go up, contrary to people who thought that the supply of labor, of low-skilled labor in China was infinite and you could never bid up the real wages. There was the factories in the coastal provinces did run into labor capacity limitations, and so they did have to start raising real wages, and prices are adjusting, and the renminbi is undergoing real appreciation, and so China does adjust like other countries. But it still has a long way to go before income per capita approaches that of the U.S. or other Western countries. So in that respect, I think that even if it were to have a hard landing or a financial crisis somewhere along the way, it would be more like what Korea's was in 97, 98, and then they pick themselves up and keep going. And so basically, I mean, China, like everyone says, is going to pass the U.S. in economic size. Not as quickly as you would think by just extrapolating 10% growth rates, but they will pass us before too long.
Passing to the issue of commodities, which is also something that is important also for Colombia. Colombia has been experiencing some sort of an oil boom, mining also, but mainly oil in the past few years. Today exports, 50% of exports are oil. also foreign direct investment. Almost half also is coming to the oil sector. You've written extensively about the curse of natural resources. So Colombia decided to follow kind of the path of Chile in implementing a fiscal rule in which some of the revenues that are coming from oil are going to be put in a fund which is going to be saved for the times where the situation is not okay. At the same time, there was a fiscal sustainability law that was approved at a constitutional level, oil royalties reform, et cetera, So Colombia started going through, this year actually, they started going through the path of a fiscal rule, which is very much linked not also to structural movements in the economy, but also to movements in the oil mining sector. What challenges do you think a country like Colombia faces at economic level mainly and social level? If you know more about it, I'm not so sure how familiar you are with Colombia, but it's part of emerging markets, it's Latin America. So what do you think are the challenges that Colombia is facing? Also talking about this situation on a fiscal level, which has been improving substantially in the past few years.
So I'm not in any respect an expert on Colombia, but as you say, I have been thinking about natural resources, oil and minerals and agricultural commodities and the pitfalls that so many countries have run into. And of course there are countries that do very well with them, but what's been so striking is that in the past they haven't been the majority of natural resource countries where performance has been disappointing. But I think we do know by now what some of the pitfalls are and how they can be addressed, and by looking at mistakes that were made in some places and by successes in other places. Certainly a part of one of the biggest pitfalls is when there's a commodity boom, and of course it isn't just Colombia that's going through this, but many countries in Latin America, in Africa, and other parts of the world are also undergoing commodity booms, or have been for the last 10 years with some ups and downs. But oil prices are definitely have been are way up. But one of the most common pitfalls is during the boom period when the price of your export commodity is high in world markets. You think this is going to go on forever, and so we can spend it on this, particularly if you're a country that still has a lot of poor people and a lot of needs. Then there's a temptation to spend it. And many governments have actually increased spending more than proportionally to the increase in the tax revenues or the royalties that they get from the boom. And then the problem is it doesn't go on forever. Some cases maybe you run out of the natural resource, but more often it's just that the world price goes back down. And then you're stuck with investment projects that are half finished, or if they're finished you can't afford to maintain them. And you have a government payroll that's that's now, in retrospect, was you expanded too big, too fast, and it's very hard to reverse these things. Historically, in developing countries in general, especially commodity producers, especially Latin America, fiscal policy has tended to be pro-cyclical, meaning destabilizing, meaning in the booms you increase the spending and you increase the height of the booms, and then in the recessions you have no choice but to cut back on spending and deepen the downturn. The good news is, since 2000, a fair number of developing countries, emerging market countries, have, including some in Latin America, have beaten that, have figured out how to run counter-cyclical policies. And as you say, I think that while there are other examples, Chile is kind of my star example in this case, because it doesn't just depend on the intelligence and and good judgment of the government officials, but they've written rules, and it is a structural budget rule that the government has to set a target for the cyclically adjusted budget and then save everything. If it's an increase, of course in Chile's case it would be copper prices. If there's an increase in the price of copper, to the extent that that's permanent, you can spend the revenue, but if it's temporary, you have to save it. And I gather that's quite similar to what you have enacted in Colombia. My research lately has been focusing on the fact that many countries that have adopted rules haven't really succeeded. The spectacular case is the Stability and Growth Pact in in Europe that we were discussing earlier, but it's true in many other parts of the world. And if a rule is not credible or not enforceable, it's not going to help, and it can sometimes even make things worse. The one aspect of Chile's fiscal institutions that I have really focused on and admire, and I think maybe is a key, a critical element, has to do with who it is that says whether a boom, whether it's a copper boom or an oil boom or just a big expansion in the economy generally, who says whether that's permanent or transitory? Who says whether it's structural or cyclical? Because it's very hard to say, of course. We economists can't be sure what the right answer is. And so what happens in so many countries is wishful thinking, overly optimistic forecasts. I studied official government forecasts for 33 countries and found in most of them they were systematically biased towards over-optimism, especially at the longer horizons, and especially during a boom, that you think a boom is going to go on forever, even though it isn't. Well, that will destroy any rule, because you just say, this is what the European countries did, the Euro countries, every time they were above the 3% limit that they were supposed to hit for budget deficits, which was often, almost without exception, they would always forecast, we're going to go back down next year, get our budget deficit below the 3% limit, even though usually they didn't. And so it's a pretty comprehensive property. So what Chile has done, which I think is the obvious explanation for why they don't have this bias towards over-optimism, their forecasts have been, if anything, pessimistic on average. It's not politicians, it's not government officials, it's nobody subject to the political process that makes a determination. They have these independent commissions of experts, one for the price of copper and one for income, that says what's structural and what's cyclical. And so I think maybe that's why that system has worked. I don't know enough about the Colombian case to know how you're handling that.
Last question. What should emerging markets do about appreciation of currencies right now? Central banks, government officials.
So I understand it's a big issue, and I know the Brazilians are hot and bothered about the currency wars, and I understand that the strength of the currencies, of which Colombian peso and the Brazilian real have been very strong, can create problems for other sectors, manufacturers or whatever. But I think some amount of appreciation makes sense in a commodity boom. I don't think you'd want to have kept the exchange rate fixed. In addition, if you're in a period where the United States and other northern countries are in recession, and they think correctly that an easy monetary policy is what makes sense for them, and you're Brazil, or Colombia, and you're in a position of much stronger growth and a tighter monetary policy makes sense for you, then that's what we have floating exchange rates for. That's why they're invented, so to speak, because then the country that needs the loose monetary policy can depreciate. Not that that's a deliberate intent of the Fed, but it's a side effect. And the currencies that are countries that are in danger of overheating, like Brazil and Colombia, and it should be China too, can appreciate. Having said that, there is such a thing as too much appreciation, and if you just do it through pure floating, you can get too much. And so I am in favor of managed floating. I'm in favor of intervening, that when you have these big inflows, the way Colombia has had, that you add to reserves, that you take part of the increase in demand for your currency by increasing the supply of your currency, and only part of it through appreciation. And then in addition, you try to do some amount of sterilization so that the increase in reserves is not completely reflected in an increase in the domestic money supply, because then you just get it in terms of inflation rather than appreciation. And raising reserve requirements is one way to do some of that sterilization. So I'm not extreme float or extreme fix person. I believe in doing managed float with some reserve accumulation and some sterilization.
No capital controls?
Well, capital controls, I mean, there's some people who might say that raising reserve requirements for banks on dollar liabilities is a form of capital control, but I wouldn't say that. Colombia, I know, has experimented in the past with capital controls, and I think pretty successfully. I mean, Chile gets all the fame for some reason, that Chile used to have this in the 80s and 90s, these controls on, which mainly changed the composition of capital inflows, didn't reduce the total, but I think changed the composition in a desirable way to reduce short-term dollar-denominated bank inflows. So under certain conditions, I think that the capital controls can be useful too, but they're also prone to abuse.
Professor Frankel, thank you very much.
My pleasure. Thank you.